when Steve invited me to participate and present today, I looked at the various videos that were online to see all of the various speakers that have spoken at this event previously, and all of them are obviously ASX listed companies that have been presenting, and so to be amongst that group, even though we are not an ASX listed entity and operate a private company, I think it's very pleased to be able to present and talk about our business and a little bit about my background. As Brian mentioned, obviously I am a Queenslander. I grew up in Queensland. So part of this discussion today, as I understand it, the format tends to provide some personal insights and background to myself, and then also provide some information as it relates to the business. So not used to really speaking about myself, but for those of you that are interested in this part of it, I'll continue on. But yeah, grew up in Brisbane. I'm a product of the 80s, I guess, in terms of when I grew up. I attended Aspley East Day School. I went to Brisbane Boys College. I went to QUT and did my business degree and MBA at QUT. And it's good to see people like Paul Warburton in the audience. Paul and I worked together at National Australia Bank over 30 years ago. So for me, banking has been really just something that I ended up falling into. My finishing school, not knowing what I wanted to do. At the time, my father sort of said to me, well, you know, I know some people at the bank, you want me to talk to them? And that was the extent of the interview that I had. And so I ended up spending 26 years working for National Australia Bank, commencing back in 1987. And so when I look at, you know, the detail of, you know, the history of Morgans, and I see that Morgans was established in 1982, I see some similarities in terms of, you know, the growth and development of Morgan's business, and I guess the history that I had growing up in Brisbane in the 1980s. And, you know, obviously through that period of time, a lot of hit songs and music that people come to remember. And Steve is an avid musical fan. And so when I think about all of the various things that have shaped me, it's no doubt that growing up in the 1980s was something that did shape me. You know, my father was involved in a legal practice here in Brisbane, and during that period of time was involved with many publicly listed companies that had their headquarters in Brisbane. And then over a period of time, a lot of those firms closed or were taken over and moved interstate or offshore. And so I guess I saw at the time that really the opportunity for me in Brisbane by the time I moved to Sydney in 2002 was pretty limited in terms of banking and finance. But it's been amazing, I guess, as an outsider now, seeing the growth and the development of Brisbane over that period of time since 2002, and the opportunity that's really provided to people. So when I think back, you know, back in my time there in the early 80s, you know, I stayed at the Sofitel the Sofitel Hotel here tonight or last night, and that was obviously something that was being built in 1982, 1984. My father was involved in the actual lease of that with the railway department when they were building the building across the station. You know, I went to school at BBC, and that was at the time the Toowong Village was being built as well. I think that was established in 1986. So a lot of these sorts of things for me are products of my experience and my growing up. And I think one of the things that did shape me was the 1987 stock market crash. You look back to that time, and I had only just started working for the bank in 1987, and in October of 87, when the stock market fell, was a fairly significant event, obviously, and something that I think has, I guess, moulded my career. One of the things that I've enjoyed over the years is to, and it's for those of you that have never read it, I'd really recommend you read a book by Trevor Sykes called Bull Riders. It's an account of all of the 1980s corporate collapses. And I think one of the things that strikes me when I think about all of the various corporate collapses that occurred in the 1980s, be it Spalvins, be it Bond, be it Christopher Skase and others, or Rothwell Corporation, National Safety Council, a whole range of different businesses. But at the heart of it, what that showed me was a lot of those businesses operated under, greed, self-interest, were able to access alternative sources of financing on lax or easy terms. But primarily it was a failure of management, and those aggressive expansions and use of financial leverage at the time did an awful lot of damage to investors, to employees and others. And so I look back on my experience through growing up through the 80s and the corporate collapses of the late 1980s, and how that impacted myself and my family and others. We went through a period in the early 90s where it was pretty difficult to get a job in Brisbane. It was a recessionary environment. There wasn't a lot of activity and economic activity. And so I think one of the things that's been very important to me over my career is thinking about the management and the people that you deal with. Do they do the right thing? Do they operate their business appropriately? Do they adhere to high corporate governance standards? And are they acting in the interests of their shareholders? And so a lot of that has really driven the way in which we think at Metrics in terms of the people we want to do business with. And, when I think of, comments about our business and the rate of growth and the expansion of our business, I think one of the things that I'm always cautious about is, we're only a small business. The banks are the big guys. It's very important to maintain an approach of a realistic sense of what you've done and where you think you can take the business and what you can achieve. But at the end of it, it is about delivering to our investors and protecting and preserving their capital, driving the right return outcome, and maintaining a very high corporate standard in terms of the way in which you interact and behave in the market. So I think, I think for me personally, that experience has been very important in terms of shaping my views about how good businesses should operate and the purpose that they bring in terms of, delivering for shareholders, delivering for employees, delivering products and services that the community and people want, and doing it in a way that's fair and appropriate. I think those sorts of things have been things that have shaped me. I also look at it and say, during that period of time in the 80s, it was clear that there was a complete failure in terms of governance and regulatory oversight. And so it's very interesting now for me in this situation now where ASIC has come out and provided this discussion paper asking the question about what is driving the movement from public markets to private markets. What is the reason for that? And what does that really what are the things that are necessary for a regulator to consider in terms of ensuring the protection of investors as investors move into private market opportunities? So that combination, I guess, my experience growing up together with where we are today, I hope will help you understand a little bit about the background and where we've got to in Metrics. So in terms of our business, Metrics Credit Partners, we established the business really coming out of the global financial crisis. So back in 2008, I worked for the National Australia Bank, as I said, spent 26 years there, always kind of feeling like I was a bit of a square peg in a round hole. But we decided at the time we could really see what was going on in the market. The banks were struggling to finance their activities. Financial markets had become quite tight. And you saw the implications that had on Australian businesses. Their ability to access finance was being impacted. The 4 domestic Australian banks were providing the financing, but a lot of the European and US banks and others fell away. So if you think about Bank of Scotland, Allied Irish Bank, all of the European banks and others, they retreated to their home market. And at the same time, you had the situation where the bail accord was coming through and impacting the way in which banks were operating. And so we formed the view that would make it difficult for a lot of Australian companies to be able to access financing. And so, we formed the view that the banks would be under increasing regulatory pressure. And that came about as a result of, the implied guarantee or the guarantee that the government provides now to retail depositors. And so that movement away from banks to a non-bank was something that we thought was appropriate in terms of trying to raise a private credit business. And so we spent a number of years working with the bank at the time. So originally pitched the proposal to the bank back in 2008 to establish a private credit business. It went through about 20 different risk management approval steps with inside the bank, a referral of the business plan to APRA. Finally, the board of the bank made the decision to invest the enormous amount of $35 to set up the business. So we started the business with $100, 65 contributed by myself and 3 of my partners, and 35 from the bank, and we sold them a 35% stake. And took a massive pay cut and convinced 2 of my partners to join me. So been very fortunate that Justin Hines and Graham McNamara joined me as partners to establish Metrics Credit Partners. And one of the reasons that drove us to do that as well is if you go back to sort of 2009, there was a lot of discussion and debate in the market about establishing a retail or reinvigorating a retail bond market, looking for retail investors to gain access to credit investment opportunities. And what that really was, it was a recognition of the fact that the banks wouldn't be able to provide the financing, and that they needed an alternative way to distribute credit assets off their balance sheet to manage risk, but also give investors access to those assets. We formed the view that if you had a fragmented market and you had a whole lot of retail clients buying bonds, then the outcome for the retail investor would be inferior to what it would be if you could aggregate capital to become a large scalable provider. You're more relevant to your borrowers, you're more relevant to your investors, you're lowering risk, and you're delivering a much better outcome than investors buying individual one-off bonds and trying to make a portfolio out of that. And so that was a big driver in terms of the establishment of Metrics. So we launched in 2012 after spending a number of years negotiating with the bank to establish the business. Here we were, 2012, secured a portfolio of assets of around about 1.2 billion. We thought that everyone would come rushing to us and there'd be floods of capital and it was going to be really easy. Of course, 12 months later, we hadn't raised a cent. And the people within the bank that were asked to assist us on distribution of our offer had all resigned and left and gone and got different jobs. And so there we were, had 1.2 billion of assets, new fund established, new corporate relationship with the bank established as our shareholder. You think you're credible, you think you've got something of value to offer, and of course no one wants it. And at the time, no one had heard of private credit or private lending. And so after 12 months, in a sort of a state of desperation, ended up making a cold call to an institutional investor down in Melbourne. And the guy today is still there. They've been invested with us now for over 12 years. They invested an initial amount of $75 million. And today that single investor has now grown that to around 4.2 billion invested across a number of our funds. So we started with one single investor, 3 employees 12 years ago, with 75 million of AUM. And today we've now grown that to over 180 people, with offices in Brisbane, Sydney, Melbourne, Auckland in New Zealand, Ireland and the UK, over 180 employees in the business, 3 Australian Stock Exchange listed funds managing in excess of $3 billion, with over 30-odd thousand investors, and a great relationship, I must say, with Pinnacle Investments. So Pinnacle Investments, a publicly listed company, came in as a shareholder, acquired the bank's interest. So in 2018, the National Australia Bank made the decision that they were looking to exit wealth management off the back of the Royal Commission. And so we suggested that perhaps they should sell their shares to us. And so they sold their 35% stake back to the management team. We acquired that, and then we sold it to Pinnacle Investments. And so Pinnacle acquired a 35% stake in the business. And Pinnacle have been a long-term supporter and assistance provider, service provider to us. They've been a distribution partner since 2013 and have assisted us enormously in terms of the capital raising activity. And so today, we've most recently announced a situation where a group called the Townsend Group and the National Pension Scheme of Korea have joined together as a partnership, and they've acquired a 4% interest in our company. So now we run over 30 individual investment vehicles. We have over 50 corporate pension fund investors from Japan, We've raised money from Asia, Hong Kong, Korea, Northern Europe, and we've most recently launched a series of vehicles called ICAV vehicles for UK and European investors to access those through Irish unlisted funds. All of that capital is effectively export industry orientated. We're raising capital from offshore investors looking to bring that back onto the onshore and to invest that into good Australian companies and projects. So our role as a lender, investor, is really to find good opportunities to do business with good quality companies and to support those companies with access to financing. For those of you that don't know our business, there are probably a number of key areas where we are active as a lender. We lend to listed and large private corporates, so a number of ASX listed groups, companies like Woolworths, Origin Energy, Brickworks, Ramsay Healthcare, a number of ASX listed companies. We're also very active in project and infrastructure funding. So in Victoria, for instance, the Peter MacCallum Cancer Centre, the Sydney desalination plant, the Victorian desalination plant. We were involved in the West Connects project, the Northwest Rail Link, all large-scale project and infrastructure financings we've been involved in. We're also involved with private equity firms where they're acquiring businesses. And so groups, all of the various private equity firms that operate in the Australian market, mid-market firms like BGH, Crescent, Next Capital, Quadrant and others, as well as the global firms like KKR and Bain and EQT. We have relationships with those firms and have supported them with their acquisitions that they've made. Real estate is a significant part of our business. So we're around 60% of our business is focused on real estate related funding. And that's primarily focused on residential property development financing and industrial. So large scale, high density residential apartment developments, large scale land subdivisions, and also industrial are the two main areas where we're active in real estate related financing. And we also are involved in structured credit. So structured credit is really providing access to corporate entities, non-bank lenders that are involved in financing consumer and small, medium-sized business lending through different structures. We also participate through the capital structure. So not only do we do senior investment grade unsecured debt, but we also participate through subordinated debt, mezzanine debt, and through to equity. And we have a range of investment vehicles that allow investors to gain exposure to private markets dependent upon their risk and return expectations. So I think the asset class is a very versatile asset class in that one end of the spectrum, it can be a defensive alternative to traditional fixed income, investing in lower risk corporate entities where you're part of providing the debt, where equity obviously wears the risk of first loss. That's really designed to be protective of investor capital through appropriate covenants, controls, the taking of security, and ensuring that the equity component wears the first risk of loss. At the other end of the risk spectrum, private credit can actually be an equity market replacement in that you can generate higher yields and higher returns, say through mezzanine debt, or debt where you're taking warrants or you've got options over equity. So depending on the risk profile of the individual borrower you're dealing with can drive the risk return outcome for investors. So our team and our skill set is really to build good long-term relationships with companies and people in the market, looking to source transaction opportunities to then structure those transactions to mitigate risk. And so when we put the financing in place, it's all about ensuring that our investors' capital is protected and preserved, and that we're driving the right return outcome for that risk profile. And so, from my perspective, then when I look at the growth of private credit, I think it's a genuine alternative to traditional banks. What our role is really to provide an alternative to corporate treasurers and CFOs that are looking to diversify their funding sources away from the reliance on the banks. And so private credit, unlike what you might sort of sometimes see in news coverage and others, we're not the lenders of last resort. We're not doing the transactions that the banks aren't involved in. It's a core component of providing financing to support companies to grow their activities. And our team and our role is really at an institutional level is about doing business with good quality companies that are driving the right outcomes for their shareholders and driving growth in terms of the activity, and making sure that our investors are getting rewarded for being that source of capital that is being provided to those companies to support their activities. So when I look at the current market debate, there is a lot of discussion at the moment about private credit. It's grown quickly. Part of that debate, I think, is fueled by competitors. Like we don't really see a lot of other fund managers in terms of competing against them for assets, but we're all competing to raise investor capital. And so I think when an asset class grows quickly, what you tend to find is that those that are missing out tend to complain, that their business isn't growing as strongly. And those that are attracted, sometimes you attract the wrong people into the sector as well, because those people may not necessarily have the background or skill set, but they can see the business opportunity to grow an asset management business. So you've got that difference between those that are growing their business based on skill set, looking to deliver for investors, others that see it as a means to grow FUM and build a funds management business. I think for Metrics, we're very much of the view that we've got the skill set, we've got the track record, and our commitment is very much to delivery for our investors. So when I look at the debate, part of the debate has always been about what is driving this move from public markets to private markets. And one of the things that the regulator has said is that if the asset class and the movement into private markets is attractive for large-scale institutional and wholesale investors, then retail investors should really have the same opportunity to participate in the asset class that large-scale institutional investors have. So the regulator isn't saying this is an asset class that retail investors shouldn't have access to. They're saying that it may present an attractive investment opportunity. But the important part then is to ensure that those that are managing money are doing it in the interest and looking after and protecting investors' interests. And that's, to me, all about good corporate governance standards and about investment mandate compliance. There's always risks in all investment markets. We're not perfect. We'll lend money to some companies and they end up with highly levered positions, and we have to work through those. But we do that to protect and preserve our investor capital. But what we are confident about is the standards upon which we operate and the governance practices and the ensuring that we are very much aligned with the interests of our investors. So from my perspective, you come back to that reason and I guess the background that I've had as growing up. It's all about good corporate behaviour. It's all about doing the right thing, and certainly within Metrics, my belief is that we as a firm do adhere to high corporate governance standards. We do put our investors' interests at the front of all other things. We don't operate businesses on the basis of self-interest. Now, I've been very fortunate. When I started this business, myself and my three other partners, when they all agreed to join the business, we all agreed that we'd be paid the same. We participated in the same amount of equity in the company. There was no hierarchy. There was no division or difference between who had a greater shareholding, who was contributing the most. We don't want egos. We want people that are focused on delivery for our investors. And I think the benefit that has delivered to our business has been a very stable, predictable partnership between myself and my three other partners, and a very predictable and stable partnership that we've had with Pinnacle. And as a result of that, we can remain focused on delivering good outcomes for our investors. And I think that's the most important thing. And so when I think back to all of the various corporate collapses of the 1980s, and I think about estate mortgage and others that have damaged investor confidence, and investment managers have failed to do the right thing, I think what we've been about is trying to differentiate ourselves, set ourselves apart, demonstrate that we have a consistent track record of ensuring that our investors' interests are protected and preserved, and we put them at the front of our thinking. So with that, hopefully you've now gained an insight into our business. So thank you.